Welcome to Chartist Masterclass. In today's video, we're going to take a deep dive into moving averages, one of the most commonly used technical indicators in the world of trading. We'll start by explaining what moving averages are, how they're calculated, and how to interpret them. Then, we'll talk about how to use moving averages in combination with other indicators, and how to apply them to real-world trading scenarios. Whether you're a beginner or an experienced trader, this video will provide you with a comprehensive understanding of moving averages and how to use them effectively in your own trading. So, let's get started. A moving average is a line that is plotted on a chart, which is calculated by taking the average of a given set of data points over a specific period of time. This data could be the closing price of a stock, for example, or some other relevant piece of information. The purpose of a moving average is to smooth out the underlying data, making it easier to identify the underlying trend. By filtering out some of the noise that is present in the raw data, moving averages can provide a clearer picture of the direction and strength of the trend. There are several different types of moving averages, each with its own unique characteristics and uses. In this video, we will be discussing these different types of moving averages in more detail, and how to use them to gain a deeper insight into the market. So if you're ready to learn more about moving averages and how to use them in your trading, let's get started. Now that we've covered the basics, let's talk about how to calculate moving averages. The most commonly used moving average is the simple moving average, which is calculated by adding up the closing prices of a security over a certain number of time periods, and then dividing that sum by the number of time periods. For example, let's say we want to calculate a 5-day moving average for a stock. We would add up the stock's closing prices for the last 5 days, and then divide that sum by 5. This would give us the average closing price for the stock over the last 5 days. But why do we use moving averages in the first place? Moving averages are a great way to smooth out fluctuations in data and see the overall trend more clearly. By averaging out the closing prices over a certain number of time periods, we can get a better sense of the stock's long-term direction, rather than just looking at its daily or hourly fluctuations. Now that we know how to calculate moving averages, let's talk about how to interpret them. A moving average line can either be rising, falling, or flat. A rising moving average line indicates that the stock is in an uptrend, while a falling moving average line indicates that the stock is in a downtrend. A flat moving average line indicates that the stock is in a sideways or consolidation phase. In addition, the slope of the moving average line can also give us insight into the strength of the trend. A steeply rising or falling moving average line indicates a strong trend, while a shallow moving average line indicates a weak trend. Now that we understand how to interpret moving averages, let's talk about how to use them in combination with other indicators. One of the most common ways to use moving averages is to look for crossovers. A crossover occurs when a shorter-term moving average crosses above or below a longer-term moving average. For example, if we have a 10-day moving average and a 30-day moving average, a crossover would occur when the 10-day moving average crosses above the 30-day moving average. This is often seen as a bullish signal, indicating that the stock may be starting to trend upwards. On the other hand, if the 10-day moving average crosses below the 30-day moving average, this is often seen as a bearish signal, indicating that the stock may be starting to trend downwards. One of the benefits of using crossovers is that they can help to smooth out some of the noise that can be present in the underlying data. For instance, if a stock is experiencing a lot of volatility, it can be difficult to determine the true direction of the trend using only the raw data. By using moving averages, we can filter out some of this noise and get a clearer picture of the underlying trend. Another way to use moving averages is to look for instances where the price of the stock is trading above or below the moving average line. When the price is above the moving average line, this is often seen as a bullish sign, indicating that the stock may be in an uptrend. On the other hand, when the price is below the moving average line, this is often seen as a bearish sign, indicating that the stock may be in a downtrend. Moving averages can also be used to identify areas of potential support and resistance. When the price of the stock is approaching a moving average line, it may encounter resistance as it tries to break through the line. Similarly, when the price is falling towards a moving average line, it may encounter support as it tries to bounce off the line. In conclusion, moving averages are a powerful tool for technical analysis. They can be used to identify trends, smooth out noisy data, and identify potential areas of support and resistance. By combining moving averages with other indicators, traders can gain a more complete picture of the market and make more informed trading decisions. In addition to the simple moving average that we discussed earlier, there are also several other common types of moving averages that traders may use in their analysis. One of these is the exponential moving average, or EMA. This type of moving average places a greater weight on the most recent data, making it more responsive to recent price changes. This can be useful for identifying short-term trends, but it can also lead to more false signals. Another common type of moving average is the weighted moving average, or WMA. This type of moving average assigns different weights to the data points, with more weight being given to the most recent data. This can help to smooth out the line and reduce the lag that is present in other types of moving averages. Lastly, there is the smoothed moving average, which is a type of moving average that uses a combination of a simple moving average and the previous period's moving average to smooth out the line. This can help to reduce the lag even further, making it a popular choice among traders. In conclusion, there are several different types of moving averages that traders may use in their analysis, each with its own unique characteristics. By understanding the strengths and weaknesses of each type of moving average, traders can choose the one that best fits their needs and use it to gain a deeper insight into the market. The exponential moving average, or EMA, is a type of moving average that places a greater weight on the most recent data. This means that it is more responsive to recent price changes. Unlike the simple moving average, which gives equal weight to each data point in the calculation, the exponential moving average assigns a greater weight to the more recent data. This means that the EMA is more responsive to recent price changes, making it a useful tool for identifying short-term trends. However, because the EMA is more sensitive to recent price changes, it can also generate more false signals. For this reason, many traders will use the EMA in combination with other indicators, such as the relative strength index or the moving average convergence divergence, to confirm their trading signals. One of the benefits of using the EMA is that it can help to reduce the lag that is present in other types of moving averages. This can make it a useful tool for identifying short-term trends, as it will be more responsive to recent price changes. However, it's important to keep in mind that the EMA is more sensitive to recent price changes, which can also lead to more false signals. As such, it's important to use the EMA in combination with other indicators and analysis techniques to get a more complete picture of the market. In conclusion, the exponential moving average is a useful tool for identifying short-term trends, but it can also generate false signals. By using it in combination with other indicators, traders can gain a more complete picture of the market and make more informed trading decisions. One of the common types of moving averages is the weighted moving average, or WMA. This type of moving average assigns different weights to the data points, with more weight being given to the most recent data. This can help to smooth out the line and reduce the lag that is present in other types of moving averages. One of the benefits of using the weighted moving average is that it can help to reduce the lag that is present in other types of moving averages. This can be useful for identifying short-term trends and making more timely trading decisions. Another benefit of the weighted moving average is that it can be customized to fit the needs of the trader. By assigning different weights to the data points, traders can control the amount of weight given to the most recent data and adjust the moving average to better fit their trading style. In addition, the weighted moving average can help to smooth out the line and reduce the amount of noise that is present in the data. This can make it easier to identify the underlying trend and make more informed trading decisions. In conclusion, the weighted moving average is a powerful tool for technical analysis. By assigning different weights to the data points, it can help to smooth out the line and reduce the lag present in other types of moving averages. This can be useful for identifying short-term trends and making more timely trading decisions. The smoothed moving average is a type of moving average that is commonly used by traders to smooth out the line and reduce the amount of lag present in other types of moving averages. It is calculated by taking a simple moving average and adding the previous period's moving average, then dividing the result by 2. One of the benefits of using the smoothed moving average is that it can help to reduce the lag that is present in other types of moving averages. Because it takes into account the previous period's moving average, it can more accurately reflect the current trend. This can be useful for identifying short-term trends and making more timely trading decisions. In addition, the smoothed moving average can help to filter out some of the noise that is present in the underlying data. By smoothing out the line, it can provide a clearer picture of the underlying trend, making it easier for traders to make more informed trading decisions. However, the smoothed moving average can also be more prone to false signals, as it may react more quickly to short-term fluctuations in the market. As with any indicator, it is important to use it in conjunction with other indicators and tools to get a more complete picture of the market. Overall, the smoothed moving average is a useful tool for technical analysis, and can be a valuable addition to a trader's toolkit. By understanding how it works and how to use it in combination with other indicators, traders can gain a deeper insight into the market and make more informed trading decisions. In conclusion, the smoothed moving average is a type of moving average that can help to reduce the lag present in other types of moving averages, making it a useful tool for identifying short-term trends. By combining it with other indicators, traders can gain a more complete picture of the market and make more informed trading decisions. In conclusion, Moving averages are a powerful tool for technical analysis. They can help traders to identify trends, smooth out noisy data, and identify potential areas of support and resistance. By combining moving averages with other indicators, traders can gain a more complete picture of the market and make more informed trading decisions. In this video, we've taken a detailed look at moving averages, including how to calculate and interpret them, and how to use them in combination with other indicators. We've also discussed some of the different types of moving averages that traders may use in their analysis, including the simple moving average, the exponential moving average, the weighted moving average, and the smoothed moving average. Now that you have a better understanding of moving averages, you can start incorporating them into your own trading strategies. As with any indicator, it's important to use moving averages in combination with other tools and indicators to get a complete picture of the market. Remember to always do your own research and analysis before making any trading decisions, and always trade safely and responsibly. If you found this video helpful and would like to learn more about technical analysis and trading, be sure to like this video, subscribe to our channel and hit the notification bell to stay up to date with our latest videos. Thank you for watching, and happy trading!